Kia ora, and welcome to the CoreLogic Property Market Update for Poutu Te Rangi, March 2024. Brought to you by Loan Market. The Aotearoa property market continues to grow in value, but the pace of gains remains patchy from month to month and region by region. Nationwide, values increased by 0.3% in February, a further easing from January's 0.4% increase, and well down on November's 1% gain. It increasingly feels like a market stuttering to get out of first gear, as demand remains constrained by tight and expensive credit. One of the clearest examples of variability was in Te Whanganui-a-Tara, Wellington, where the monthly growth rate has bounced from 0.8% in December to 0.1% in January and 0.6% in February. Te Whanganui-a-Tara, Wellington's strength in February was a contrast to the other main centres, where growth was either 0.1% or 0.2% in each of Kirikiriroa, Hamilton, Tauranga, Ōtautahi, Christchurch, Tamaki Makaurau, Auckland and Ōtepoti, Dunedin. Further afield to our other main urban areas, and the numbers swung a bit wider, from a negative 0.4% fall in both Heretaunga, Hastings and Rotorua, to 0.8% gains in both Te Awa, Kairangi ki Tai, Lower Hutt and Kapiti Coast, and 0.9% growth in the regular against-the-trend tourism mecca of Tahuna, Queenstown. While in some communities the talk of recovery has started to focus on when values get back to the recent peak, Tahuna, Queenstown has already exceeded that level. Not that it experienced much of a downturn in the first place. A chronic housing shortage, combined with unwavering demand for property in such a stunning setting, has ensured the housing market there defies gravity, unlike so many adventure-seeking tourists jumping off bridges and out of planes across the area. In regulatory news, the government recently confirmed the plan to progressively reinstate full interest cost deductibility for investors, with the tax year beginning 1 April 2025 being the first to have the full allowance back. This is no doubt welcome news for investors, who will have been pinching the pennies themselves with increasing interest rates and the cost of everything leaving them questioning the financials. However, the improved tax returns are unlikely to cause a flood of investors both willing and able to significantly increase their portfolios and therefore share of sales. Interestingly, February did see a slight bump to investor purchase activity as confidence and expectation of medium to long-term capital gain returns to the market. But it's still early days. We'll be watching closely to see if the trend continues or if it's just a blip. In recent times, we've also heard from the Housing Minister, Chris Bishop, about plans to reform the Resource Management Act, improve infrastructure funding, lower building costs and free up more land for developing. There's still more detail to come from the Minister, but it has to be said that the intention is clear and well-meaning, and very ambitious. The Ōtautahi Christchurch example, following the 2010-2011 earthquakes, appears to be a good working example of how to enable a lot of building over a decent period of time. From a broader construction industry perspective, vulnerability remains, as potential liquidations hit headlines and large losses are recorded. Uncertainty and wavering confidence is certainly doing nothing to arrest the fall in building consents being issued. The annual total has fallen below 37,000 at the end of January, down from the peak of over 51,000 at the end of May 2022. Recent forecasts published from minister briefings and the National Construction Pipeline Report have this total reducing to as low as 30 to 35,000, which may be relatively palatable, but any lower would be of much greater concern, especially with population growth so high and likely to stay that way for a while. We need to keep building houses and units for our rapidly increasing population. For those already in the market, mortgage interest rates will continue to dominate their thinking. At the end of January, 57.2% of all mortgages have less than a year to go at their current rate. And while the gap between current and future interest rates won't be as great as it used to be, there'll still be an adjustment required for borrowers. Mortgage arrears, according to Centrix, have continued to increase. They remain comparable with pre-pandemic times. Consumer arrears, however, look a little more worrisome, with 13.1% of the credit-active population in arrears to some degree, the highest since February 2017. Perhaps it was these data which loomed large in the minds of the Reserve Bank Monetary Policy Committee with their latest decision to hold the OCR flat at 5.5%. Despite a bit of doubt creeping in for the hold, following ANZ's outlier forecast of 2 more increases, the Reserve Bank were much less worried about the potential upside surprises to inflation and appeared comfortable with the current level of tightening. Their forward projections were also a little more relaxed than many had expected. We've seen a few minor adjustments down for some short-term interest rates at the banks. so expectation has firmly shifted to the position that we're past the worst of the tightening cycle. Hopes, dreams, or expectations of rate cuts should probably be shelved though, as this doesn't look likely and certainly not meaningfully so at any stage this year. To stay on top of all the latest economic and housing market metrics throughout the year, be sure to follow our news updates on the CoreLogic NZ social channels, including LinkedIn, Instagram, X or Facebook. Download our latest monthly chart pack and subscribe to the New Zealand Property Market Podcast on all good podcast players. Mā te wā.